Hey everyone, and welcome to This Explainer. Today we're going to completely unpack the journey of a business asset. We're getting right into the weeds of exactly how, and more importantly, why we calculate its loss in value over time.
Okay, so here's our game plan. We'll start with the core concept of fixed assets, then tackle why we actually calculate depreciation, look at the accounting treatment behind it, break down the straight line method, and finally, run through some practical, real-world examples. Let's get into it. Section 1, the concept of fixed assets. To really get this, we kind of have to reframe how we view the massive purchases a business makes. See, the absolutely crucial point here is that when a factory buys a massive piece of machinery, they aren't just buying tons of metal and wires. They are literally buying a bundle of future services and benefits. These assets aren't bought just to be flipped for a quick profit. They're kept to drive the production process over multiple financial periods. And in the accounting world, they're recorded at their full historical cost. So the purchase price plus every single dime it took to get that asset up and running. But here's the million-dollar question we have to ask ourselves. What actually happens to this shiny new asset as it cranks out products day after day, year after year? I mean, that bundle of services gets used up, right?
Section 2. Why calculate depreciation? That question brings us right to the core issue of accounting for the passage of time.
To actually measure this steady drop in value, we need to gather 4 specific puzzle pieces. First, the total historical cost we just mentioned. Second, its useful life, meaning realistically how long management thinks this thing will run. Third, its scrap value, which is what it'll be worth as junk or salvage at the very end. And finally, the exact time period it was used during the financial year. Now, you might be wondering, why go through all this math? Well, it absolutely matters. It keeps our profits completely accurate by matching the cost of the asset right against the revenue it helps generate. It keeps the balance sheet honest by showing the real declining value of the asset. And on a purely practical level, it ensures a business has funds essentially saved up to eventually replace that worn-out asset without completely tanking the company's cash flow down the road. Right, moving on to Section 3, the accounting treatment of depreciation. Let's actually look at how we get this onto the books. So you've got this stark contrast between the 2 main ways to record the loss. On one hand, you have the direct method, which just hacks away at the value of the asset account itself. But standard accounting rules heavily favor the indirect method. Why? Well, it's all about transparency. It keeps the original historical cost untouched on the books while tracking all that lost value in a completely separate accumulated account. To actually log this using that preferred indirect method, accountants follow a really strict sequence at year-end. They debit the depreciation expense account, recognizing the cost for that specific year, and then they credit the accumulated depreciation account. Finally, that expense is closed out to the income summary to impact the ultimate bottom line profit. Section 4. The straight line method. Now that we know the rules of the game, let's look at the absolute most straightforward tool for calculating the numbers. The straight line method does exactly what it sounds like. It assumes the asset provides equal, steady value every single year of its life. To figure this out, we just take the original historical cost, subtract the estimated scrap value, and divide whatever is left by its estimated useful life in years. It smoothly assigns an equal, flat chunk of the cost to every single year. Or, if you're more of a percentages person, you can find the annual depreciation rate first. Just divide the number 1 by the useful life and multiply by 100. That gives you a flat percentage rate that you can just apply to the cost minus the scrap value. Either way you slice it, both paths get you to the exact same depreciation expense. Section 5. Practical examples and applications. Okay, let's take all this abstract math and anchor in reality. Let's run some actual numbers. Imagine a scenario where a business buys a massive, heavy-duty machine for 600,000 dinars. Management expects to run this thing for exactly 8 years, and at the end of that marathon, they figure they can sell off the scraps for about 50,000 dinars. When we drop those numbers into our straight-line formula, we take the 600,000 original cost and subtract the $50,000 scrap value. That leaves us with a depreciable base of 550,000 dinars. Then we simply divide that 550,000 by the 8 years of useful life. And boom! That gives us exactly 68,750 dinars. That is the exact amount of depreciation the company needs to record every single year for the next 8 years. And hey, just to prove the math works, if we use the rate method for those 8 years, we do 1 divided by 8 times 100, which gives us a steady 12.5% annual rate. And wouldn't you know it, 12.5% of 550,000 dinars is, once again, exactly 68,750 dinars. So here is the whole shebang coming together in the final step. That 68,750 dinars hits the income statement as an expense, lowering the taxable profit. Simultaneously, it builds up in the accumulated depreciation account over on the balance sheet, neatly tucked right under that original 600,000 dinar historical value. Let's hit one more quick scenario just to totally lock this in. Say a company car is bought right on January 1st for 40,000 dinars. It also happens to have an 8-year useful life and an estimated 4,000 dinars scrap value at the end. Using the exact same logic we just applied, we remove the 4,000 dinar scrap value, leaving 36,000 dinars to be depreciated over its life. Dividing that 36,000 by 8 years gives us a clean, easy annual depreciation expense of 4,500 dinars. And once again, we see the beautiful dual nature of accounting. The 4,500 dinar expense hits the income statement, while the balance sheet tracks the car's predictably declining book value year after year. It's mathematical proof that, sadly, the new car smell doesn't last forever, and neither does the car's value.
But wait, while this method is super simple to calculate, critics are quick to point out that it's definitely not perfect. It completely ignores the reality that older machines usually cost way more to maintain in their final years. Plus, it assumes a perfectly steady level of use, acting like years where a machine works twice as hard to meet a massive production surge simply don't happen. Which leaves us with a pretty fascinating final thought to chew on. If the straight-line method is just too basic and rigid for assets that lose most of their value right out of the box, what more advanced, dynamic methods are accountants actually using behind the scenes to balance the books? Hold on to that question as you continue exploring the financial world. Thanks so much for diving into this explainer with me today.